Guess what came in the mail today? My silver eagles from SD Bullion. Awesome. I just received my silver eagles from the big boys with offices on Wall Street. Look at the expensive box they came in. Did your coins come in a pretty blue package? No, just a well-packaged plain brown box. Oh, I bet you wish yours came in a fancy blue box like my coins came in. I wasn't buying fancy boxes. I was buying silver eagles. I'd rather save a couple $100. But my pretty blue box shipped for free. Nothing is free. They might not have charged you shipping, but your orders still cost you hundreds of dollars more. SD Bullion only charges a flat rate of $7.77 for shipping, regardless of order size. Do the math. And if you used your credit card, you paid 4% or more in credit card fees compared to SD Bullion's lowest in industry, 3% credit card fee. That's almost an extra $20 on your 100-ounce order. I never was good at math. What are you going to do with that fancy blue box anyway? I threw it away. Next time, do the math. Order from SD Bullion. Brown boxes, $7.77 flat rate shipping, and 3% credit card fees. Join the over 15,000 new customers who have recently made the switch to SD Bullion. Why pay more?
This is the Doc and Eric Dubin with the SD Weekly Metals and Markets Wrap. Well, we had the November jobs report today, Eric, and it was a huge shocker as it beat expectations by 211,000, and the market is now expecting a December rate hike at the FOMC meeting. And what's interesting, Eric, is that gold and silver shot higher on the jobs report and the rate hike expectations. Traditionally, over the past few years, anytime the Fed talks about rate hikes, gold and silver have been smashed. But today, both gold and silver exploded higher on the jobs report release. Silver jumped from under $14 less than a day ago to about $14.60, and gold surged higher from about the $10.50 level that it had been support to nearly $10.90 over the past 24 hours. It's certainly been quite interesting market action. So what's your take here, Eric, on the payrolls report and gold and silver's response?
Well, the payroll reports is the same old story that we're seeing all the time, where the vast majority of the jobs that are being reported are these part-time jobs, and 319,000 jobs in the part-time category is what lifted this particular report above the consensus expectations. And we should also say too, John Hilsenrath, the mouthpiece, quote unquote, and that's not my pejorative, but people within the mainstream even refer to him that way. He's the mouthpiece of the Federal Reserve. He is their go-to guy at the Wall Street Journal when the Federal Reserve wants to leak stories and tweak the market. And as well, we also learned earlier this week with a fine story that came out of Zero Hedge, where it was revealed that the Federal Reserve has been actively putting leaks out to manage expectations in their MOPE process, the Management of Perspective Economics, using the term that Jim Sinclair coined. So here we are. We have this news come out, and they're trying to set up the ability to do a 25 basis point hike or maybe a 10 basis point hike on the December 15-16 meeting. And we've been saying for a month now as well that we will probably see a upward movement in precious metals upon their token rate hike because of just the fact that it had been priced in for over a year. I mean, they've been talking. Actually, it's fair to say that you can even, to some extent, look at green shoots, Bernanke comments going back all the way to 2010 as the start of this kind of waltz dance that the Federal Reserve monkeys and Management of Perspective Economics driven policy that they do when it comes to job owning, that they have been hanging the threat of higher interest rates over the precious metals market for years. So to see the reaction among traders to jump into the precious metals as we record this Friday morning, there's only a couple hours left before the markets close and gold and silver have taken off to the upside. That's not surprising. It speaks more to probably the whole dynamic as well of the bullion bank traders looking, and the folks that are executing this policy in service of government interests, they actually have set up the hedge fund players and all the copycat folks that have been pushing gold and silver down as momentum trades. They've set them up to fleece them once again, where they're taking the other side as they cover some of their older shorts in their overall book position by fleecing these relatively new positions that have been put on in the last few weeks and months. And we'll probably set up to see a small continuation of upside in precious metals because of that, because they don't go short consistently. They play a game of going back and forth. So now that
for as much as the shorts had reached historic levels in late October, they've earlier this week they've completely switched.
Yeah. I mean, this pattern's happened over and over again. So that's what we're seeing here now. And we took Thanksgiving weekend or week off from recording, and the show prior to that, we were talking about how it basically looks like we're in a bottom period with the precious metals, and I think that analysis still holds, because silver traded pretty much on a closing basis with just within a 20-cent band in the last couple of weeks. I mean, sure, we've seen some tails with down intraday moves on a candlestick chart basis on days like yesterday and earlier this week and whatnot that got us below 13 or 14 level. But the overall fact remains that earlier this year, when we did have that retail shortage, and we were once again threatening the 14 level, the real prices that people had to pay in the physical market was closer to 20, if not higher, for some retail products. And the condition of the paper manipulation game is such that it's really hard for the cartel to get prices much below where they are now, because it creates more physical demand, particularly in Asia. And that's why we keep bouncing in this area, and they don't get any further traction. And nevertheless, we still hear lots of people screaming about how, well, we're going to go to 800 gold or even 250 gold and $8 silver or whatever. And I don't think that that's in the cards. And when you see the kind of reversals that we see today, I think that is prima facie evidence that, once again, you see that kind of background conditions in the market that suggest that we are going through a bottom. But people will look at or take those statements and say, well, you're excessively forecasting a bottom, and that's not my intent. My intent is to try to understand what's going on in terms of the supply-demand dynamics, including the paper shenanigans. And it really does look like that's where we are, and that the hedge fund folks that have been lured by the nose to take excessive short positions are about to get fleeced. How far that goes remains to be seen. Maybe we're only going to get what I talked about a couple weeks back, where it would be like a 70-day period of general upside, a January effect, and new money's coming in just from generic portfolio repositioning by the standard or conventional Wall Street management money folk. And it really doesn't take a lot for those monies to make a difference in the gold market, because there's so few people in the West that actually hold gold and silver, paper or otherwise.
Speaking of the physical market and what we saw over Q3, really the demand has continued, hasn't been quite to the extent that we saw in Q3, but earlier this week the U.S. Mint has set a new all-time sales record in Silver Eagles that are now at 44,850,000 coins sold in 2015, with it looks like 2 more weeks of production, so they're going to be banging right up to the 47 million mark. The next 2 weeks' allocations have been what recent weeks have been. So that's going to be almost 3 million coins higher than the previous record. And as we were discussing before the show, Eric, it probably would have been an easy 5 to 10 million coins higher if they hadn't been allocating coins throughout all of Q3. And that's, in my opinion, a pretty conservative number.
Yeah, and if they were allocating coins, we wouldn't have seen those sky-high premiums, $6 plus on the Silver Eagle. So the amount of demand that was flowing in based on, concerns about what's going on with Shemitah and everything in this September period, October period, we would have seen a lot more sales out of the Mint.
Interestingly, is we had talked during that September period, there was a lot of speculation and rumors that U.S. Mint officials were threatening to shut down production for the year in early October. Thankfully, that didn't happen. Quite interestingly, they've actually ran out of gold coins before they've run out of silver coins. Over the past week, the Mint has sold out of quarter-ounce gold eagles, and about a week ago now, 1-ounce gold eagles, which is a bit surprising to me anyways, that they ran out of gold coins before the silver coins for the 2015 model.
I mean, just to totally speculate, and it's nothing more, but you can easily see a scenario where the amount of interest in the precious metal space for North American buyers for physical is just marginal at best. I mean, the severity of this browbeating that people have taken has made people just despise the sector. And it was actually somewhat surprising that we saw as much demand as we did in the summer going into the fall, in my opinion, frankly, given the carnage that has happened. So I think to some extent, one can make the argument with, again, no basis by which I can prove this, but it sure seems like the powers that be that work with the Mint made the Mint start signaling those kind of position opportunities where they could, decide to curtail production and push everything out and close things down because the physical simply is not available to support mass market demand. And as soon as prices start going up, that's what brings in the Western buyers. They chase prices higher, and it fits. The points here fit the scenario. So who knows? Maybe that's what was going on.
And that's what's so amazing about the U.S. Mint and really the Canadian Mint as well as their coin sales over the past really 5 years. I mean, ever since the spring of 2011, you haven't seen any new demand of chasing prices or the traditional Western market of excitement generating new customers to the market. I mean, 2015, you didn't see any new customers coming to the market because gold and silver were the exciting sector. I mean, we're talking about stackers here going all in and throwing every dime they could find from under the mattress, under the couch.
Selling the dog.
Out of their kids' piggy banks they're raiding. That's where this demand's coming from. And you're talking about record sales sustained over 40 million coins just on one coin, the Silver Eagles, year after year. Imagine what's ahead when this market finally does turn around, whether that has begun or not, whether that's 6 months or a year away or we're in the early stages of it, and you see the next exciting bull run and the general public tries to get involved.
And institutional data quants like Ibsen Associates and so forth have estimated that the total exposure to precious metals in the North American market is on the order of about 1.02 or so % of financial assets in aggregate. And that's counting paper gold and paper silver.
Yeah, 90% of that's going to be GLD, SLV, mining shares, any form of paper, not physical.
Yeah, so the amount of the buying power that the stacker community is representing is so small, and it really doesn't take much to move the market higher. So we'll see where things go when it comes to 2016 overall, but I'm pretty confident that at least with respect to the next 60 some odd days that we're going to see on average higher prices. Sure, we're going to see fits and starts and cartel capping along the way, and it's going to look really ugly here and there, but yeah, we're going to probably see kind of like what happened back in the transition from 2014 to 2015. We peaked out on January 24th, if memory serves, and still stayed a little bit high through the end of January and whatnot, but then cartel brought things down. But anyway, yesterday also was pretty interesting when it came to how the dollar responded to what went on with the euro, and we were talking about how prices get priced in and how traders try to get in front of news such that they can benefit from it, and that happened with the euro. The dollar fell relative to the euro because the euro was falling all throughout the last month or so in expectation that Draghi was going to come out and actually increase QE for the ECB, and the expectation was that they were looking for the markets were expecting about 60 billion to be announced, and in fact, a cut in interest rates as well. Neither that happened. Draghi kind of took a middle road by declaring that they'll have intentions of running QE as far out as 2019, and in fact even further if need be. I mean, he basically is parroting the same message that he's been doing ever since he launched QE, which is that he would do whatever it takes, quote unquote. And so far the market's actually believing him, despite all of the craziness that we can see under the surface in terms of Deutsche Bank and other very, very sick banks that are in the Eurozone. One of the things, though, that we should point out that was pretty interesting in the comments that he's made was that the ECB is now overtly telling the market that it will also consider the purchase of assets that are euro-denominated in specific zones. Like, for example, they didn't say this, but I can see the writing on the wall. They expect that the ECB is probably going to be purchasing Greek debt, and that this QE program, kind of like how QE2 was used and QE3 was used to mop up bad assets in the real estate sector that are on the bank balance sheets in the United States, they're probably going to use the QE program to help smooth over what's going on with Greece, because the political dimension is completely intractable. In fact, what's going on in Greece now, this week, we saw the trade unions protesting and the beginning rumblings of the left there coming to terms with the fact that the political party they put in power in Tsipras and his whole campaign to bamboozle people to go along with continuing the debt service of the ECB and the IMF and so forth, the Troika. The Greeks are recognizing that they've been screwed. And I think this is following along the timeline I talked about beginning in the summer, where everyone was fearful that Greece was going to fall apart in the summer, but it's going to be a delayed reaction, and it's starting now. It's this window that I talked about where it would take time for the political machinations on the ground and the realization amongst the average person just how badly they've been screwed. And the forces of political control in the European Union are so strong that, just as another example, a few weeks ago, Portugal elected a parliament majority that would have put in leftists in control of Portugal, and the standing government basically nullified the election and said, we can't do this because it would be against national security interests, and they shut down. The anti-austerity parties win. That's how complete the control is when it comes to politicians and the bureaucrats and the technocratic elite that's running Europe through Brussels and the Troika, and it's just astounding to watch. But anyway, that's just a tangent, and it's relevant for next year because I think Greece is going to blow up again. So anyway, it's just amazing to see how the dollar could lose over 2 points on the U.S. dollar index yesterday, and precious metals respond slightly positively and then drift downward, particularly silver. I mean, is that but the best example we've seen all month of manipulation in action? I mean, whenever the dollar is rising and gold falls, the media will tell us that gold's falling because of the strength in the dollar, but it can't go the other way around. So another story that we should make a mention of, about a week and a half ago or so, I was blocked on Facebook. They took out all of the posts that I have put over the years. We're talking about thousands of posts that were memory hold. I still had the ability to post on the a corporate account for the News Doctors and Silver Doctors and my personal wall, but posting on all other accounts were blocked, and I couldn't even post a comment. I couldn't even post a like on some other public board. I mean, that's how draconian Facebook was. And they sent me an alert that basically said that your account has been suspended or it has a limited ability for the next 7 days, and didn't inform me as to what kind of transgression they were barking about. I'm not entirely sure what precipitated it, whether it was a specific post, whether it was a specific post in a specific forum, and I suspect that it may have in fact been coverage about Paris, and anything smacking of a false flag analysis was shot down, not just by posts that I've seen for myself, but other stuff. And in fact, We Are Change had their website blocked in Paris and I think as well in all of France. And the group that they have on Facebook, where there's over 16,000 people, was eviscerated when it came to posts about Paris. I mean, one day there were probably about 30 or whatever that were critical in analysis, and then the day which my account went dark, I also noticed that posts throughout that whole forum were also eviscerated. So it's pretty sad to see this kind of thing, because the censorship and the restrictions on our civil liberties do not increase our safety. They do not improve the intelligence agency's ability to find terrorists and block terrorists. Never mind all the other dimensions that we can talk about when it comes to possible false flags and whatnot. I mean, that's another subject. And about 84 some odd % of the French people would like to see greater security and are willing to sacrifice their freedoms for that security. And it's an illusion, because no matter what kind of benefits that the powers that be claim from restricting free speech and so forth, it actually doesn't procure security at all. And we're going to see in the United States at some point huge efforts to shut down alternative media. And I'm a little bothered, a little disappointed with the degree to which the alternative media here has not covered what happened in France. And in fact, even my own case, I mean, I fully documented and showed what Facebook did with my account. And there were some very fine people that covered that news, and it's out there. But the fact that this kind of thing is just brushed aside and people don't talk about it should be concerning to people. We're on the verge of seeing the constitutional republic of the United States thrown in the trash can. It's coming, folks, and envisioning how to stop it is hard to do. I don't know what the answers are, but I do know that we have a problem where enough people in the United States are aware of what's going on, and they're just not speaking out. I mean, there are probably about 30 million people in the United States that really do understand what's going on with our problems in our monetary system, with the use of terrorism as a tool to facilitate foreign policy. And one of the things that really needs to happen to prevent the kind of ability that the powers that be have to basically bamboozle the public and create political dynamics that serve their interests are that these 30 million some odd people need to start talking to other people, and even talking amongst themselves. I mean, I know there are people who are listening to my voice now and hearing me say 30 million people, and they laugh. They think, well, no way, it can't be that high. Well, I think it is that high. I think we are around 10, 12, some odd 13, whatever % of people in the United States that really do get what's going on. And if people are so afraid as to not want to share a message on Facebook about someone who's an accredited journalist getting hammered by Facebook with outright censorship because they're afraid of getting flack themselves, well, then we're screwed, folks. The powers that be fear nothing more than the fact that there are millions of people who are awake. And while I don't profess to know all of the answers as to how we're going to pull ourselves out of this mess, I do know that we're not going to be able to succeed if we're all coward and fear and not willing to speak truth to power. So, I think that's a take-home message that I want to say when it comes to the experience I just had with Facebook. My account has been restored, and they know that I know that they censored me and that I have been talking to people and soliciting legal advice. And if it happens again, it will be documented and actions may be taken. So, on that note, I hope everyone has a great weekend and happy holidays.
All right. Well, before we wrap up the show, then circling back to gold and silver and the action here with the looming Fed rate hike, Eric, certainly seems like you believe things are setting up for a rally through about mid-January. Stepping back a bit to the long picture, I think Obviously, it'll be a few months before we can tell with much certainty, but the events that we've witnessed over the last couple of weeks certainly have the potential to become market shifting. And by market shifting, I mean that the shift from the 4 to 5 year correction we've been enduring into the next stage of the bull market. I know that's been bannered about for a lot of times over the past couple of years, but it certainly has the potential, in my opinion, to be that. Obviously, it'll be a couple of months before we can say that with any certainty, but in today's actions seem to substantiate that, in my opinion, where we have the market pretty much confirming that a rate hike is imminent, and rather than getting smashed, gold and silver pop higher.
It's also interesting, too, is that the conventional finance world basically has priced in the expectation for over the next year or so of 80 some odd basis point increase in Fed funds. And then if you go another 12 months out, they're expecting another 60 basis points. And then another 12 months out, another 40 on top of that. So you do have this forward expectation of a quote-unquote normalization of the interest rate paradigm. And I think that is just, people are delusional because the perceptions of the underlying strength of the economy are entirely painted. They're not real. And what will be really interesting to see next year is when the economy begins to roll over, as I expect it will, and when people come to terms with that higher probability outcome when retail sales are reported in January as being real stinky, what's going to happen to forward expectations about interest rates? And particularly, all the more important in that analysis will be the fact that people are going to look back with a possible one and done rate thesis, and then all of a sudden begin to question whether the Fed has the ability to raise rates at all going forward. So that's going to be the story in the first quarter. And I think
we're looking at a situation where either way is going to be positive for gold and silver. If somehow they're able to continue to raise rates token for the next, say, 12 to 18 months, I think gold and silver are going to have bottomed and rally. And if it's a one and done and the economy rolls over and suddenly QE4 is released, the entire market is going to realize, holy crap. And it's going to be a complete sentiment change. It's going to become panic out of the dollar, and you're going to see gold and silver react much differently than they did the last time. So to me, regardless of what they do at this point, the stage is set for gold and silver to move higher over the intermediate term. So we'll see.
And we've already gotten to the stage where a huge percentage of forward production in both gold and silver are now going to not make it to the market because of the damage that's been done with this artificial pricing. You have that. You have just, the underlying rot in the system is going to get harder for the powers that be to juggle and hide. The oil sector, the energy sector overall, is now finally getting to the stage where the bad debts that are there under the surface will no longer be able to be swept under the rug. And, we have seen this whole issue of the derivatives market having a problem with having not enough collateral to support those trades. And, the part of what was, interesting with this whole ECB shift is that can in fact impact how the Federal Reserve will be looking at using repos and reverse repos as well too. So there's a lot of things in flux, and I think that all these spinning plates that our grand masters at central banks are somehow managing to spin and juggle are just going to get far more complicated as things go on. I mean, there's never been a rate cycle change, even in periods where they were far less complex and with a system that was far less leveraged than it is today. Nevertheless, there's never been a cycle where the Fed has never been able to shift policy without breaking things. It's just 40 years of history. Wherever they want to change their orientation with interest rates, and something breaks. And this time around, it's going to be a monumental break, given the distortions in the bond market, and then in turn what that has done to all other assets. I think 2016 is probably going to see some serious market corrections. Throughout this entire year, even going back to fourth quarter of last year, despite most people in the alternative asset space pounding the table about 2015 having various periods where we were going to have outright crashes, the death of the dollar, the complete crisis in Greece, on and on. It's been very clear that enough of the conventional money management world that controls the vast majority of money under management have been willing to play the game of musical chairs long enough to get us through 2015. And I don't think we're going to get through 2016 without things crashing. So, and then when you add on top of what's going on from a geopolitical and political front, it's downright depressing. But that's where we are, and that's why we are in the space that we are in. Looking at precious metals as insurance, portfolio insurance.
All right, sure. Certainly shaping up to be an interesting December and early beginning to 2016. So, all right, we'll wrap up this week's show there. So for the Doc and Eric Dubin, thanks for tuning in to this week's SD Weekly Metals and Markets.